When we look to build a portfolio, we look to build it with the highest quality companies at the most attractive valuations. So the very first part of that screening process would be quality, and we're looking for companies that have durability with their franchise, companies that have good free cash flow, that are strong balance sheets, smart management teams, and then the second cut would be valuation, to make sure that those companies are attractively valued, looking at price to earnings, price to book, price to free cash flow, things that we consider important. And then that would really lead us to a portfolio generally between 80 and 100 names. So it's really quality and valuation that we're looking for. We don't. We certainly recognize that volatility has increased significantly this year. And in fact, one statistic I saw showed that in the number of 1% moves in the S&P 500, there were 3 times as many 1% moves in the first quarter of 18 than in all of 2017, meaning that the market was going either up a lot or down a lot much more frequently in 18 than in 17. So we know that that volatility has increased, but we want to make sure that we're thinking about investing and selecting stocks for the next 3, 5, 7, 10 years, and not really focused on what's happening day to day or even over a few week time period. Financials are about 30% of the portfolio, and that's about the weight that's in our index, roughly 30%. But if you actually looked at the portfolio, not by sector but by industry, you would actually see that with inside financials, we are overweight major banks, names like JP Morgan Chase, Goldman Sachs, and actually underweight the real estate investment trust industry. So we much favor the banks versus REITs. And hopefully, again, these are some of the stocks that are still pretty cheap in the marketplace. A stock like JP Morgan Chase trades probably for about 12 times forward earnings and maybe a little more than 1.5 times book value with a decent dividend yield. And they're paying back us, the shareholder, in the form of higher dividends and buying back stock. And those are things we like. So we prefer banks over REITs, but financials are a pretty big part of our portfolio. I mean, there's been a lot in the paper on, the whole trade war with China. And the reality is, China doesn't want a trade war with the US. The US doesn't want a trade war with China, but they do have a considerable surplus to the US when it comes to trade. So President Trump is making some noise to make sure that he can bring China to the negotiating table and essentially have China buy more of our goods so that we can reduce that surplus. The reality is, really no one benefits from a trade war, because ultimately what ends up happening is the consumer ends up having to pay higher prices for everything that they want to own. So, part of the things that China was talking about with putting tariffs on, like cars and airplanes. So I guess technically if you owned airplane stocks and if you owned car company stocks, that's a direct impact to your portfolio. But again, we're thinking much longer term, and just because we hear something potentially could happen with the trade war, we're not trying to move away from the sectors or the industries that the president of China says he wants to put tariffs on, because the reality is it very well may not happen. And ultimately we're trying to find stocks that we can own for 5, 7, 10 years, much longer term, and not trying to be caught up in the day-to-day noise that I think right now is happening with threats of a trade war.